Hello students. So welcome to part 2 of our full consolidation walkthrough. In case it's been a few days since you looked at part 1, just a reminder that in part 1 we looked at the basic data and additional information for this consolidation, and we also went through all of the calculations that you need to do to correctly come up with your consolidated income statement and statement of financial position. So in this part we're going to do these two statements, and we're going to look at our calculation of net income first and see how you can take that calculation and put it into your income statement. So let's go to that calculation and look at forming your income statement pretty much line by line and do that. So here's where we were for our calculation of consolidated income. We were at 91.24. And just a reminder, we had taken out the dividends from the subsidiary, added the realized gain on equipment. This is, by the way, at net. So that was that's going to be less depreciation expense, which increases income, but we're going to charge the tax on the income statement. Then we took the income of Tofino, we added the net realized gain from beginning inventory, we took away the unrealized gain from ending inventory, and we also charged our ADA and goodwill impairment for the year. So let's see where this takes us on an income statement. So first of all, this column I have here is the two companies that we're trying to combine. So I've taken the number from the two individual company income statements, Lunenburg and Tofino, and this is simply like L plus T, and that's our starting point. Now the first thing we do is we have to eliminate from this all intercompany sales. So recall that intercompany sales for the year were a total of $24,000. So we take this away from sales and we take this away from cost of goods sold. And that's so that we're not reporting sales to each other externally. We're only counting sales to external parties. We take this away from both sales and cost of goods sold, and notice if you take away the revenue and you take away the expense, the net effect, the net effect is zero. So that's where we're going to start. Now, we had two adjustments to cost of goods sold. This 11.8 is a subtraction, notice, and keep in mind cost of goods sold is an expense. If we deduct an expense, we're actually increasing net income. So this 11.8 is the amount of unrealized profit from the end of year 8 that we did realize in year 9. So that number you're going to find in your table. Here's the 11.8 in the intercompany inventory profit table. Now notice this is before tax, because when it comes to the realized profit in inventory, we want to get that back. So we're deducting that from cost of goods sold. But next I want to draw your attention to the tax at 47.20. So when we do this, we'll get there. When we do this, here's the deduction from cost of goods sold, increasing our income. And in this line, income tax expense, here's the related tax that we're going to charge ourselves. So if you took the 11.8 and then took away the 47.20 tax, you'll notice that the net is the 70.80 from your calculation. So in your calculation, we use the net. On the income statement, we're adjusting cost of goods sold to go down to add income, but we're charging the tax. Now, in a very similar way, the 9,000 is the unrealized profit before tax from the end of year 9. So because it's unrealized profit, it's inside the net income of these two companies. Specifically, this is an upstream sale. It's in the net income of Tofino. So we're eliminating this profit by increasing an expense account cost of goods sold. So again, unrealized end of year profit before tax, increased cost of goods sold. That reduces income. So we've taken away the profit. But if we're not going to let ourselves have the profit, we don't want to incur the tax expense. So under your income tax expense line, we're going to take away the tax that goes with the 9,000. So at 40%, that's the tax. And I'm not going to show you again in the intercompany sale area, but basically it was 9,000 less 3,600. And what we did is over here, we took away the net in our calculation. So notice that for both the realized profit and the unrealized profit, these are at net in our calculation, but each of them has a cost of goods sold and an income tax item on the income statement, equaling the net amount. Okay, so that takes care of a big part of our income statement. Now, just want to mention this dividend from S. So this becomes zero. It does not become minus 2744 in the income statement. So the income of Lunenburg included the dividend from S. So here's other revenue from the Lunenburg income statement. Part of that other revenue was 2744 dividend from Tofino. We take that away, and as you can see, we're lower yet from 72.80. The $600 is the intercompany consulting fee. So this was a revenue to Lunenburg, and it was an expense to Tofino. So we're taking 600 away from other revenue and 600 away from other expense. Okay. Now let's look at just the fact that selling and administrative expense did not have an adjustment. I'll just skip down to goodwill impairment. This goodwill impairment is from your ADA table. So you already did that really near the beginning of this problem. Pick up that number, and that is your goodwill impairment. That leaves us a few numbers to look at. First of all, depreciation. So for depreciation expense, this $200 comes from the original fair value increase to equipment when we took over this company. So I do want to show you that one. So notice on our ADA table, here's our ADA table, we had an extra $200 of depreciation in year 9 because the equipment fair value increment happened over 10 years. So this is 1/10 of the original 2,000. So from your ADA table, this is more depreciation expense. In contrast to the other amount of money here. So the year's depreciation on this intercompany equipment sale that is realized through the purchasing company's use of the machine was 180. So that 180 has, we've said, been earned through their use of that machinery. So the parent sold this to the subsidiary. So we're saying our depreciation expense is going down. And once again, if we lower an expense, our income goes up. So we're not saying that we made another 180 in revenue, we're just dropping depreciation expense. And the related tax is 72. So I'll take you back to the income statement in just a moment. But basically, in our calculation, we used a net of 108. But this is really minus depreciation because we say we gained that portion. If we gained it, we have to charge ourselves the tax. So there's the 180 and the 72. So let's look at that. Here under depreciation expense is our 180 minus, and here is charging the tax. And you'll notice the difference is $108. And here we've, in our calculation, we have 108 after tax realized gain. So that, again, that 108 turns into two numbers on your income statement. Now our calculation was 9124, and we've just gone over all of the numbers in the income statement, and we get 9124. So that's a good sign. And I made some notes on these here. I think I've discussed these with you, but I'll just let you have a look at these comments that I've typed out beside the numbers. If you're interested, you could pause the video and have a good look at these comments. Okay. The other statement that we're going to look at is the statement of financial position. And there are a lot of key items in here. Here's our calculation of consolidated retained earnings. We ended up with 36,248, and here's our calculation of NCI balance sheet. And we went over these in some detail in part 1, so we're not going to go over them again in part 2, but these are two key numbers that we needed to do our balance sheet. I might just call it a balance sheet. So let's look at the adjustments on the balance sheet, keeping in mind that the two numbers from these calculations are the bottom of your balance sheet. It's not a plug. These should make it balance if you've done everything right. So here again, Lunenburg plus Tofino, right there. And let's look at changes. So first of all, we have the change for $9,000. So this I don't know how that got there. Excuse me. That minus $9,000 for inventory is the before tax amount of unrealized inventory profit. And this number here corresponds to this number here, cost of goods sold. So as you figure out these consolidations, I'd like you to see really clearly, I hope, the pattern that we're following. If you take unrealized profit in ending inventory and you add it to cost of goods sold, then that plus 9 on the income statement becomes minus 9 on the balance sheet. We're just saying the inventory on hand in Lunenburg's inventory. If you take away that unrealized profit before tax, you take away 9,000. It's the same number. Now, what about tax? You recall from the income statement we just did that the tax on that 9,000 was 3,600. So I'm just going to show you again. Here's our income tax expense minus 3,600. So 40% of the 3,600. We reduced our income tax expense. I guess you could say, well, where did it go? If you reduce an expense, that means your company made more. When a company makes more, it has more in retained earnings. So there is an equal and opposite amount on the balance sheet. So as we reduced the income tax expense, we increased the deferred tax asset on the consolidated balance sheet. So that's where that is. Now the other part of this deferred tax asset, 216, is what's remaining to be profited and charged to tax in the intercompany equipment sale. So let's make sure we just have a look at that. We'll find it here. Here's our intercompany equipment sale. So you saw this table in the part 1 video. Notice that the balance at the end of year 9 is 540 still unrealized. And that is 216 worth of tax. So our deferred tax asset is still 216 for that unrealized equipment profit. As we take that profit every year, our deferred tax asset is going to go down. And similarly, these two numbers from property, plant, and equipment come from your tables. The $800 is the remaining fair value increase from the date of acquisition. So remember that was $2,000 and we've depreciated $1,200 of that. There's $800 left. So this is the balance from your ADA table. I'm not going to go up there because I think you probably remember it. If not, you can go to the part 1 video or earlier in this video and have a look. The 540 we just did look at, that is the remaining profit before tax to be realized from the intercompany equipment sale. So in terms of the value of equipment, 540 is unearned, so we can't say our equipment is worth 31,000. We're saying it's 31,000 minus the 540 that is still not earned, but plus the 800 from the original fair value increase. And again, that's on our ADA table. Now, goodwill, I just want to caution you about goodwill. You have to be careful. If you just add the two balance sheets together, L plus T in this case, you're not going to find goodwill because goodwill was calculated for consolidation. It's not on the books of Lunenburg, not on the books of Tofino. So don't forget to put it on your balance sheet. So this is the number from the final balance of our ADA table for goodwill. We started larger, we had a couple of impairment charges, and now we're at 37,840. So just make sure you don't forget this, okay? Now, that gives us total assets of 123,196. So when you're doing your work, this is what you're shooting for, really hoping for the best here. And here's our current liabilities that had no changes. Our long-term liabilities had no changes. We just used the common shares of the parent. The retained earnings and common shares of the subsidiary have been eliminated. And then we have, from our calculations, NCI balance sheet and consolidated retained earnings. These are the two numbers that should help you balance. And we do. So very good. We balanced. If you don't balance, one of the generally best things you can do is to find the difference between the two numbers and see if there's anything anywhere in your consolidation that matches the difference. And if you had forgotten goodwill, you'd be off by 37,840, and you'd probably find it after a little bit of looking around. So it's really important that you do that. Okay, now I've just put a little more information on this spreadsheet, and I just wanted to show you one other thing before we wrap up this video. And this is looking at equipment less accumulated depreciation. So generally speaking, and certainly in my courses, if you see data for a question and it shows equipment at net, then you have to say, well, showing equipment at net is the reporting standard, and you have to show your equipment at net when you do your balance sheet. But similarly, lots of questions show equipment at historical cost less accumulated depreciation. And of course, at cost less accumulated depreciation should give you the exact same number as if you calculate at net, but showing cost less accumulated depreciation is the reporting standard. So if that's what you're seeing in your question, pretty much everywhere you're going to have to figure out historical cost of equipment and adjust that, and then take your accumulated depreciation and adjust that. And I'm just going to go another little minus X here. Whoops. And let's discuss this. Okay, so this is going to be helpful if you do see a question that shows equipment and accumulated depreciation. Now, in our data here, we don't have those numbers. So basically, this would simply be Lunenburg plus Tofino equipment on the balance sheet, and this would be Lunenburg plus Tofino accumulated depreciation. And here are the adjustments that we would have to make. This plus 2,000 is the full increase, the fair value increase at time of acquisition. So plus 2,000. And in a similar way, this accumulated depreciation is all of the extra depreciation for the 6 years. Remember, we bought these guys in year 5. So year 5, 6, 7, 8, 4. Anyway, what did I get here? Better keep it straight here. $1,200 was the total from your ADA table. So if we take plus 2,000 for equipment minus 1,200 accumulated depreciation, the difference is obviously $800. And here, if we're showing property, plant, and equipment net, there's our plus 800. So that works out. Now, the other part of this is your intercompany equipment sale. So if we're talking equipment at cost, the first thing we're going to do is take away the whole $1,440 of gain. And remember, we're realizing that gain over time. And our accumulated depreciation for that has been over here on our income statement, $180 a year. So what we need to do is realize that accumulated depreciation, here's a trick, it accumulates. It's not 180, it's all of those years times 180. So we've had accumulated depreciation on that intercompany equipment sale of minus $900. And of course, the difference between these two is going to be I hope it's the 540. Sorry, 23. I did that wrong. That's the 540. So up on our income statement, if we have a look at that, where are we? 180 a year. Oh, sorry, I want to look at the balance sheet. So here's our minus 540 for property, plant, and equipment. So we're going minus 540 as the total, but if we were doing this at cost less accumulated depreciation, we would have both of these numbers and they would net to 540. So I hope you can see that in both cases, we're netting to the same number that we have above in the way that we decided to do our balance sheet. Now, one last little thing. This is a detail that you'll certainly see in my course, and I'm not sure if you're taking this somewhere else, if you'll see this detail or not. But what I have here is minus X, is the accumulated depreciation of the subsidiary at the date of acquisition. So part of what we're doing when we take over this subsidiary is we're saying, okay, what is the book value of equipment? And the book value, of course, is cost less accumulated depreciation. So we're essentially taking over this equipment at book value plus or minus any fair value increase or decrease. So for both equipment and accumulated depreciation, this is minus your subsidiary's accumulated depreciation at acquisition. And again, we don't have the figures in here, but it's easy enough to find. If you're doing a question and they give you the subsidiary's accumulated depreciation, then this is a minus and a minus. Now notice a minus and a minus cancel out to 0. So there's not going to be a change to the amount of the difference anyway, but what's going to happen is it's going to make your equipment amount smaller and it's going to make your accumulated depreciation smaller. So again, we're shrinking that balance sheet, not showing the subsidiary's original accumulated depreciation. So anyway, I think that pretty much wraps up part 2 of this video. Here's a final look at our balance sheet that balanced, and that's what you can do. You can easily make some small mistakes in your consolidation, but if you spend enough time on it, you will eventually find the problems. Just double check everything, look for the differential, and you will eventually find the error if you did make an error. But this one worked out, so I hope you enjoy this 2-part series.